This conference will now be recorded.
Good afternoon, everyone. This is Kathy Neifeld with Agency One, and I am pleased to welcome you to the second webinar in our three-part series with Annexus. And this webinar is going to feature Tom Haines, who's the Senior Vice President of Capital Markets and Index Solutions for Annexus. And in this WebEx or webinar, we're going to review the index strategies that Annexus is using in their products with Nationwide and Securian. And Tom is going to discuss how they've built these products and how they work with these investment funds and companies. And we're going to be discussing the PRISM Index, which is an S&P index, and the MOZAIC Index. And we're going to get granular so you have a better understanding as to how these products work and how you're going to be able to offer them to your clients. So I don't want to take up any of Tom's precious time on this WebEx, so I'm going to turn it over to you, Tom, now, and thank you.
Well, good morning, good afternoon, everyone. Thank you so much for being on today. Obviously, most of you, I think, from your homes and markets are volatile, and I know your clients are still nervous when they're seeing negative oil prices and record low interest rates. So we really appreciate you taking time out of your schedule. So in terms of this partnership, my role at Annexus is I'm actually based in the New York City area. Probably, if you've heard from Gonzalo, Annexus is actually based in Scottsdale, Arizona. We've been around since 2005, and James Hahn, head of our IUL Life Distribution, on the line today. I work closely with who's dialing in from Scottsdale. But I joined Annexus about 3 years ago, and I was working with them probably for about 5 years. And what my role is at Annexus is I lead our capital markets and index solutions group. So what does that mean? Through the whole growth of the IUL market and the fixed index annuity market, there's been a growth of utilizing smart beta indices. Indices going beyond S&P 500. And we're going to touch why that's important today. But if you're going to go outside of using an S&P 500 crediting strategy, and there's lots of reasons to do so in this marketplace, you want to make sure the index holds up. And that's really what you're going to hear from me. So my experience has been on Wall Street for nearly 20 years. My whole career has been fostered on index-based solutions. And the foundation of that, I have a quantitative finance degree from James Madison University. And after getting out of JMU, I've traded indices. I worked at the New York Stock Exchange on the development of many indices and exchange-traded products. And then I've spent a lot of time in the investment banking world, most recently before joining Annexus, running solution structuring at UBS, developing indices, and actually the last 7 or 8 years, specifically for the FIA and IUL marketplace. So I won't go on and on about my background, but that's just a little what my role is to go into New York City, to work with the banks, to make sure on behalf of our insurance companies that we're getting fair, stable, and competitive pricing. I also work very closely with our academic partners, such as Roger Ibbotson of the Yale School. We also on other products with the Nobel laureate Bob Shiller and Jeremy Siegel. And in those cases, we want to work with our academic index partners to ensure that we're building robust indices. So as I talked about, we have an index diligence process. Just as our insurance companies have a product construction diligence process, to be able to build a robust product that's going to work on a go-forward basis, we actually have to start evaluating the potential indices that come to market. From there, we're going to interview the banks and interview the investment firms or the academics driving these strategies. And through a course of a conversation, you're going to be able to come up and say, well, why did you build that index? What's the rationale driving that? So you'd be surprised just in a conversation how much can come out to understand, is there really an index built upon fundamental science, or is it shenanigan? Anyone can build a good back test, but is it going to work going forward? And that really brings me to the next point, determine. what part of our process is to determine the index is going to not just work on a back test or an illustration. I don't build indices, nor does Annexus build indices for AG49. What we do is we want to make sure that it works once it goes live, once it goes out into the marketplace. So that's a big part of it. We want to determine that the index, which is a rules-based solution, besides having the best intents to work, that it actually works, making sure that it's free of mathematical errors. You'd be surprised. Some people might have the best intentions and the best concepts of understanding how economics and microcycles work, but if the methodology is wrong, it's incorrect, then we have to make sure it determines that it models are correct. And then what we do is we select. We ensure we work, as I said, closely with our insurance partner, not to just give you an academic exercise, because we realize with your clients are utilizing these for a whole host of reasons within their portfolio management purposes. Some of them might be doing premium finance, a whole host of issues that they'd be looking at these for not 5 or 2 or 5 years, but 10, 15, 20, or 30 years. So when we're selecting that index, we want to make sure that it's applicable within the IUL construct, that the par rates are competitive now and at renewals or at additional contributions, so that your clients are often able to receive the product they've expected. So what have we done differently here? I would say to start, even going back to the last slide, Annexus is probably the only organization in the insurance and FIA, fixed index annuity, IUL market that actually has a pretty robust diligence process in place. A lot of times that process has been given to an actuary at an insurance company, and actuaries have really good understanding of mortality risk and longevity risk. They don't understand the investment strategies. When you think about what's happened in the markets over the last 30 or 40 days, we've seen unprecedented things. They're not understanding of all of these things. They're focused really on actuarial risks. And unfortunately, a lot of insurance companies put their actuaries to do the diligence, and the diligence is simply looking at a back test. That's really flawed, and we can talk a little bit about that. The other thing that really sets Annexus apart, and that's why we really value the academic foundation that we bring to the table, is we look beyond just saying S&P 500 and bonds and cash. To go a little more technical, Harry Markowitz, the Nobel laureate, now he's in his 90s, was really the first to give us the concept of modern portfolio theory, that in portfolio management, there was an efficient allocation to equities, bonds, and cash to drive returns while lowering risk. Well, that's worked for many years, and that concept, that math model works. But think about it. When interest rates are at 53 basis points, the 10-year yield, we've seen equities in the last 20 years have 3 bear markets. Global equities have had 4 to 5 bear markets. We have to think beyond. And even in an IUL construct where 0 could be our hero, we want to do better than that. So what we've done is we've really looked at what we call factor science, the ability to look at things such as value, size, momentum, quality. Those that are doing portfolio management, you're aware of those factors. I can't promise you that any of those are going to work on a given year, but I believe that a mix of those over your holding period, your client's holding period at IUL, are going to give you returns that are going to propel above just looking at equity and bond returns. So we spend a lot of time to make sure that when we're bringing you a strategy, that it is rich in factors. And I'm not just saying one index, but across the board in what we offer. So as I alluded to earlier, for the IUL marketplace, really, I think 5 years ago, for the FIA market 8 years ago, there was just really the S&P 500. The S&P 500 now is 63 years old. And when you looked at an illustration, let's just take AG49, who has the higher buy-up rate, who has the higher multiple. At the end of the day, everyone's using the S&P 500. And now what we've seen is now that there's more use of smart beta FIAs, I get in AG49, it's based on the illustration of the cap of the S&P 500, which is odd. But a lot of times when you look at other data, we look at just back tests and returns, and we think, oh, the insurance company, be it the whatever insurance company, is showing me some sort of ledger page that shows a 10 or 11% return over the last 15, 20 years. Well, just because it's sitting on a ledger page doesn't mean it's going to work on a go-forward basis. That, and a lot of, I think, agents believe that. But you got to remember, the insurance company didn't do diligence on the index. They're just showing you a back test. And many of these indices have been built by investment banks. So for those in the IUL market, if you think about it, you go through the list of firms building these indices, I would say a lot of investment bank names. And we work with investment banks, such as JP Morgan, but investment banks are not fiduciaries. Investment banks here in New York area, their goal is to get more hedges to provide the liability management for the insurance company. And the more hedges they get, the better they're recognized within their organization, the better they're compensated. So they're not paid based on performance of the strategy. So all too often, with that fierce competition of the smartest minds on Wall Street competing for that business, they end up sometimes keeping their principles on the sidelines. And you will see higher rates of susceptibility of data mining, cherry picking, these topics that we'll talk about that really could infringe on the ability of an index to work on a go-forward basis. So that's what we do. We spend a lot of time looking at that. One of the reasons I'm getting off of the idea of IUL for a second, or FIAs, why we need an index diligence process, I'm going to tell you about a story of a firm that you might be aware of if you're doing managed accounts or mutual funds, called F Squared. F Squared was based in the Boston area. And they were founded in 2007 by a man named Howard Present. And they were really reviewed by 2008, 2009 to solve the holy grail of managed money or mutual funds, meaning they developed a strategy that when markets were volatile, it would be able to go to cash. And when markets were less volatile or trending positive, it would be able to go in the market and participate. And it didn't need an insurance contract. It didn't need an option. And all of a sudden, people said, wow, you've solved the holy grail. Well, they ended up raising $28 billion in about a 6-year period. That's astronomical. In the 15 years that Annexus has been around, Annexus has raised $40 billion in premium. We're really proud by that number, but to think that $28 billion was raised that quickly is astronomical. Well, F Squared, these were managed money solutions. They were an SEC investment advisor, and they were regulated by the SEC. So what happens when you're regulated by the SEC? You end up going through audits occasionally. And during an SEC audit around 2013, it was found that F Squared misrepresented product returns dating back to 2001. The algorithm was actually created by a college intern in 2008. So to think you're going to build a $28 billion business based on an algorithm built by a college intern, that's crazy. I believe in interns. I started my career as an intern. But to build a foundation, a framework, especially a regulated framework for clients, off of that is mind-boggling. And interns make mistakes. That's why they're called interns. So what happens? The intern made a mistake, and I call it back to the future science. When they were doing their analysis on how that tactical strategy worked, they actually were able to made a mistake in their Excel file and said, well, what did the market do next week? I'm going to make my investment decision based on that. Well, that's not possible. I call that back to the future science. So when they fixed that issue, the backtest showed $138,000 of the return, not $235,000. So the one thing I didn't highlight here is Howard Present knew about this intern's mistake for many, many years, and he hid it. He hid it from his colleagues, colleagues in accounting, back office, sales. He hid it from his clients. So what happens? Howard Present and F Squared, they're shut down. The SEC charges them with fraud. They're out of business, $35 million fine. Howard Present personally, he was found guilty in a court in 2017, had to give back all of his F Squared earnings to the SEC, but it doesn't stop there. And what happened was 18 firms were charged with fraud, including this gentleman here, Louis Navalier. Navalier is probably well known to some of you that have read his books over the years or used to see him on Bloomberg or CNBC. I don't see him much on TV nowadays because he was charged with fraud because according to public documents on the SEC's website, his compliance officer emailed Navalier numerous times saying, Navalier, did you do any diligence on F Squared? Because they had F Squared allocations within their managed account models. And Navalier turned a blind eye. So he's been going back and forth with the SEC on this for years. So we'll see ultimately how that ends up. But the point is, we don't want any of you to be the next Louis Navier. We realize how hard it is that you are building up your reputations in your communities. That's probably the best way of advertising. We understand that many of you are really thinking about this in the best interest of your clients. Some of you might be really taking a fiduciary principle, an outlook on this. And if you are, you can't afford to be the next Louis Navier. That's one of the key reasons why we at Annexus believe in index diligence. From an Annexus perspective, we want our strategies to work. We don't want to get up to apologize in a few years of a problem. We can't guarantee market performance year on year out. These are long-term products. What we can do is ensure that we've taken all the steps that we can take to mitigate these kind of issues. So if you can't tell by now, I'm pretty passionate about this stuff. I really love indexing and trying to do it the right way, and we'll talk about how we think about it. But one of the reasons that really triggered my personal passions at this was, I kid you not, 8 years ago now, I was at the Royal Bank of Scotland, and my boss wanted to build an index with this man's employer. And this man, or that you probably recognize on TV, is Mr. Cohen. You know, he recently actually left jail. He was the personal attorney to Mr. Trump, going back for many years. And as you know, he was found guilty of corruption and spent jail time till recently with this COVID crisis. And Mr. Cohen, Michael Cohen, was personally calling my trading desk trying to get an index branded with his employer's name. It would be no different than if I was wearing a tie with the Trump brand. He was trying to build an index, and the index had no fundamental science backed on it. It was a complete vanity exercise. And Mr. Cohen was trying to get a mandate, a trade in the index annuity market, in the IUL market, and was calling a lot to do this. And ultimately, my managers wanted to do the deal. It was my executive management that was concerned by it. It was me who was concerned by it. And I actually made a decision, probably a risky one, to go around my boss, to go to the executive management and raise my concerns with this. This strategy lacked fundamental science. This has nothing to do with right wing or left wing. This is, was there any fundamental science driving this index? And their answer was no. So ultimately, the executive management, my firm, and myself thwarted the development of this index. It's not in the market. But from that point forward, I realized if people like, you know, Mr. Cohen, Michael Cohen, is trying to seek an index in our market, a lot of people are. You'd be surprised how many eyes are in this marketplace. So there's really two things that can drive a poorly designed index. There's ignorance and deception. I think we'd all agree that Howard Present is deception, but ignorance is just as bad. As I said, what happens if the best intentions and you're incorrect in the model design? Or what happens if you're new to Wall Street, you're a young upcoming star, and you really fail to understand how markets have worked over the last 20, 30, 40, 50, 60 years? You've really just looked at how markets worked in the last 10. Well, that's not going to work, because that leads you to really having false expectations when you build strategies, and gives you a higher risk of having your strategies do poorly on a go-forward basis. So we look to make sure that we're working with partners that bring wisdom and honesty to the table. Even if you have the best intentions, ignorance is just as bad. So as I said, one of the things that I wanted to share with you was in the first step of our diligence process was the concept of interviewing firms that build indices and hearing why they build it. So when I joined Annexus, I started to go into New York representing Annexus, and all of a sudden my former counterparts were pitching me an index, hoping to get an FIA or an IUL index mandate into our products. And I want to share with you just some of the quotes that have came from those conversations, and they're pretty eye-opening. As I mentioned, these Wall Street bankers, even though they might have a Series 7, they're not fiduciaries. And they're under a lot of pressure to win deals. So I know many of them, I know their bosses, and unfortunately, some of the things that I got from those meetings, asking them about their indices, was pretty eye-awakening. So here's a quote. Don't repeat this, but we are aware of the poor structuring design that we made designing index XYZ that's still in the market. So this is a situation where I was with a bank, a major European investment bank, and at the time, a junior structure gets up while they're pitching me an index and said, you know, we had this flaw that's still in the market for this index XYZ, but we fixed it for you. So going forward, if you select this index, you're not going to have that problem. We corrected that error. And I thought to myself, well, where's the recall function? What happens if I was in Detroit and I was working at Ford Motor and an airbag manufacturer comes and said, Ford engineer, we fixed the issue in the airbags, but that issue is still out there and the Chrysler models out on the roads. How would I feel? How would I feel for the good of the public? Pretty bad. That's not a type of partner we want. We want people to have the gumption to realize that they made a mistake, to call the recall feature, to do the right thing. Here's another story. I was meeting an index firm, index bank, and they were pitching me on an index, and I saw a lot of bond risk in the allocation. And it seemed like in a rising rate environment, the strategy would underperform dramatically, go down in value. So I say, well, how's this index going to work on a go-forward basis if rates rise? And this is the answer I got. Why does a go-forward index performance story matter? Marketers only care about backtesting. That's not who we want to work with. That's not a partner. But again, people are just falling in, not just the salespeople, but so is the investment banks, into how's it illustrate. We don't care about illustrations. We care about illustrations plus forecasts to make sure things work on a go-forward basis. And then here's another one. And by the way, in COVID-19, this index is going down 32%. This is an index in the FI market. But I'm pitching an index. It's a second version of an index. One's already, as I mentioned, in the index annuity market. And they're pitching it to us. I did my diligence on it. And I found the index was doing poorly back in the 1990s. During the financial tech bubble collapse, it did very poorly. So I called the bank. I sent them my data. And I said, I'm struggling here to see how this holds up in this period of time. You know what the bank says to me? They said that, what you see on the quote. We know, we developed the strategy now to drive sales now, but we knew it had done poorly prior to 2001. And I think to myself, I'm not just trying to put you in a product for the next 12 months. You're clients in this product for 25, 30, 40 years perhaps. In those cases, you could have a situation where we have markets back to 1998. I know we might not feel that now, but we've had a lot of market volatility. We've had low interest rates, and sure enough, the type of strategy design did do poorly in this last month. So this is my last one. 5 years ago, I'm at UBS still. I'm at an industry event, and a major U.S. investment bank wins a mandate with a major U.S. insurance company. And the bank puts their brand on an index. So I go up to the firm. It was the firm, the insurance company was kind of competing, putting this out to the Wall Street to win the deal. And I go up to the gentleman who's at the firm, at the bank, who's a lawyer, by the way. And I said, congratulations on winning the mandate. I thought he'd say thank you, and that was that. He'd say, I would not buy that strategy personally. I was shocked. Why would he even say that? Well, guess what? That strategy's done about 2% over the last 5 years. So maybe, I guess he was right. But unfortunately, people aren't rewarded for performance. They're rewarded to get deals that bring hedges onto Wall Street. So what do we try to do when we do that diligence to make sure that, let's say people have interviewed appropriately. They've said the right things to me. We're not going to stop there. We got to look at the data. The data also helps tell the truth. And when we find that, there's really two common themes that come to mind that we really have to look at. There's cherry picking and there's data mining. So what are those? So cherry picking is the idea where you have a financial back test, right? And in that back test, you actually are setting the start date of the back test to make the strategy performance look the best. So if you look right here, here's an example of the strategy I was pitched about 3 years ago. A big bank was pitching it for a major asset manager. And I get a glossy fact sheet, one that you'd get from a wholesaler or a marketer at any point. And it looks very attractive. And I said, would you like to know more about the strategy? Would you like to potentially get this in one of your products? I said, I'd like to do more diligence. I'm very interested. Please send me more. So I said, send me the Excel file. A few days go by, I get the Excel file, and I get 4 more years of data in the Excel file. And I called the bank, and I said, I'm confused. Why is there 4 more years of data in the Excel file? And they said to me, oh, you weren't supposed to receive that Excel file. We've decided to start the back test in 2002 to make the data look the best. Well, when I took this to Ron Schertz, co-founder of Annexus, and told him this, I'm in like week 3 at Annexus, he goes, I hope we're not launching that index in 2. You never will work with that partner. They're being deceptive now. When are they going to be deceptive on another issue? So these are the shenanigans that we do continue to see. The last one is data mining. Data mining is twofold. One, it could be a person that is really just trying to optimize the backtest. Is a person hitting the spreadsheet file to really engineer it? Or one, the other concept is what they're putting all this financial data into a computer and allowing the computer to develop the strategy, have the best test. Well, that lacks a scientific method. It's optimized to maximize the backtesting, and usually they struggle to maintain long-term performance. Here's an example of the first FI index ever done really in the smart beta world. And this is an index called the ALTVI index. It's a perfect example where Royal Bank of Scotland and SBL meet on this index in 2011. By the time that the index goes live into the product, look at that. It already delves down like 15%, and now going forward, it should continue to do poorly. The point of that is you've got to look out. That's a red flag. We want to make sure that that data can hold up and there's a fun factor science driving these strong returns. Just like those that remember, you might have children in school, or you remember from your school days, the idea of scientific method. Well, we still apply the scientific method to our strategies. We believe factor science drives strong returns. You know, financial index development is based upon that. That's one of the reasons we work with Ibbotson, Siegel, and Shiller in our practices across our product line at Annexus. These are financial rock stars. They're not financial rock stars because they're hip people. They're financial rock stars because they've spent decades in their reputations and careers seeking the truth in financial analysis and data. And usually their research, which all of it, many of the research is award-winning. That award-winning research is a great foundation to develop strategies that can work on a go-forward basis. Not that it's going to work every given year, but they're based upon scientific methods. It's more robust. And that's one of the reasons we've seen having better chances of luck, of success, working with indices built upon academic science. So that's really what I wanted to highlight. And again, one of the values of doing that is we're looking beyond the lens of just how to optimize a backtest for the last 10 or 15 years with equities, bonds, and cash, and looking in different lenses, looking how to go global, looking how to bring factors into play to really have you have best position to support that diversification during your client's holding period. So for those that don't know, what is a factor? I'll go through it briefly. We call these we refer to what Andrew Ang says at BlackRock. Factors like momentum, size, value, and quality. Winners, smaller cap stocks, as Warren Buffett says, value. Stocks that are well priced for the amount of earnings that they drive, or quality, consistency of having a company drive earnings, drive profit margin. Those factors over the long run tend to be good micronutrients that are actually having that long-term positive return. So in kind of conclusion to this section, we do have a diligence checklist that we can share with you. And when we do our diligence checklist, we want to make sure that our indices are selected with factors and based upon fundamental science. Is there academic research on the strategy? And if they're building in a new factor, a new concept into the model, is that based on academic research? And is that robust? Is the asset manager involved in building an index? Sometimes we see asset managers getting involved in index development. But we have to ask ourselves, if they are involved, are they taking a fiduciary viewpoint on this? Are they using the same models within their fiduciary practice? Are we being the guinea pig? Because we don't want to be the guinea pig. We want to make sure there's no cherry picking, no data mining. We focus on long-term performance, not the recency bias of how it did the last year, or even the recency bias of the last 10 years. We want to think about how it could do in numerous market cycles. I'd rather, and you'll hear it from James as you work more and more with him and his team, we seek to hit singles and doubles with our indexes so we have that better long-term performance in the long run. And minimize bets. You've heard me talk about diversification. And we think about the IUL market, which brings me to the next point here in a minute. A lot of it's just betting on the S&P 500. Well, there's a whole host of market points we can get access to. International markets, commodities, bonds. There's so many strategies to allocate to. There's so many factors. So we really believe by having a robust, sound, fundamental foundation, utilizing those tools, that you're going to minimize bets. We're not in the betting market. We're not. And have a forward-looking mindset. How are these strategies going to work on a go-forward basis? Not just how they did the last 10 years. So I'll just pause there for a second. Before I continue, James, do you want to add anything?
Yeah, I would, no, Tom, the only thing I would add to this is the couple takeaways that I want everyone to have thus far before we move forward is, at the end of the day, we want to make sure that that you have this peace of mind that from a Nexus standpoint, we want our hand on our heart to say, is it the right thing on a going forward basis? Tom, you made a great point. We can't control markets, but we can control to make sure that due diligence process on a going forward basis is sound. And that's really important. We want to give you, the advisor, as well as Agency One as our partner with the Annexus, to have that peace of mind. That's one. And secondly, it really is about meeting the expectations of the client. Tom, to your point about the S&P chassis that we've seen, and I know the next section, a couple, 3 slides, you're really talking about what's been sold out in the marketplace, but how are we viewing it different on a going forward basis on how we can meet the expectations of the client, where today on the S&P chassis, we really feel that we're letting we're not going to meet the expectation of the client. Okay, so I'll let you kind of segue to that section.
Yeah, so we spend a lot. One of the things that we are so blessed to have at Annexus is, as I highlighted, our academic partnerships. I'm on the phone, especially over, not just over COVID-19, but over many years, we regularly connect with Professor Shiller, Professor Ibbotson, Jeremy Siegel, where they really are sharing their market insight. So we really have a prowess of bringing that expertise in. As you'll get to know, we have a partner, and one of our partners is Blackstone. They have a minority interest in our company, and Blackstone has a really gifted investment strategist, Joe Zeidel, who looks at all the portfolio of companies of Blackstone. Blackstone's actually viewed to be the 3rd biggest employer in the world, or in the United States, I should say. So when you look at that, they're looking at data that no one else can look at. And then we work with major insurance companies. So by looking at working with all 3 lenses and having a really trusted partnership with all 3, we get different perspectives from them. But when we put that together, it's really interesting to get then a more robust and sound viewpoint of where markets are probably going. And I know COVID-19 has just happened, but I actually developed this right before COVID-19. And I think that you're going to see it's a little bit played out, and not that we predicted COVID-19, but one of the things that we found overall is probably markets were going to be different the last 10 years. You can't base everything on the last 10 years. And really what I give this analogy, and I think it's still appropriate. Now it's going to be Tampa Bay, so I should have changed my slide. But over the last 10 years, Tom Brady in fantasy football, for those that know fantasy football, if you have a friend that do it, must be you or a neighbor, you kind of predict how to create the best team of different players and how they're going to do during the year. And there's big drafts. You're probably aware of those draft parties and so forth. Well, over the last 10 years, going into those drafts, Tom Brady had the best ranking, one of the best, not the best, I would say the 7th best ranking of quarterbacks, which makes sense. He won a lot of Super Bowls. He's probably one of the best quarterbacks ever. And he had a really strong rating the last 10 years. Now, going into this past season or going into next season, do we really think that Tom Brady's ranked the 7th best quarterback in the NFL? Do we really think he's going to even be the 7th best for the next decade? No. What actually happened in the fantasy football draft last August was, on average, he was ranked 24th best quarterback. So here, when people are putting money up, maybe with their friends or however they do fantasy football pools, okay, they're saying he's ranked 24th. Well, when you're sitting out at fantasy football, you're basing things not on the last 10, you're basing things on really where you think the next 10 are going to be, or the next year, I should say. So the irony is, when we talk about financial planning, why are we going to use the S&P 500's last 10 to forecast how it's going to do the next 10? Even why would we use the last 25? It doesn't matter. What we really need to do is think on a forecasting framework to not be perfectly right. As the late Jack Bogle told us, anyone that tells you a forecast and is going to be 100% right, you can't trust them. But what Jack Bogle told us was, A forecast provides more realistic expectations on a go-forward basis. And those realistic expectations help you to create more robust financial plans for your clients. So, that's big focus. And when we work with our academic partners, one is Bob Shiller, the Nobel laureate, and he has a forecasting framework called CAPE. So it's the same model that actually drives our indices and some of our FIA products. And what it does is it looks at long-term inflation-adjusted price earnings ratios. So what I want to show you is Bob did this going back since the 1880s. And actually going into the end of the year here, now I'll tell you where it is now, it was the third most overvalued market in over 125 years. And what I was telling people, I said, the only markets that were more overvalued were the Roaring 20s and the tech bubble. And we know how those ended up. And I was saying, Bob doesn't believe that we're going to have the next Great Depression or tech collapse. But this is the third most overvalued market in over that 140-year period. Do we really think that markets are going to continue to do 13.5% in the next decade? No. Now, no one have predicted COVID going into this, but markets were overvalued going into COVID. It was one big domino that was already on the table. One more domino. COVID was really the finger that put it down, but that created a big domino going into this decade. And now, actually, this CAPE ratio is around 23. So maybe markets are a little more fairly valued, but they're not undervalued by any means. Bob actually still thinks the market's return with dividends is probably around 5.5%, 6.5% going forward. You take away dividends, Bob Shiller thinks it's a 4.5% to 5.5% return. Not a lot on a go-forward basis. Not the 10% that we see in some illustrations. And then, what about around the world? The U.S. economy did so well off of the financial collapse recovery. It was one of the most undervalued markets in 2009. But in the end of 2019, the CAPE ratio in the United States was the most overvalued, and international markets were the most undervalued. There was better opportunities in the long run to go in those markets. I realize that COVID-19 has taken down, China was hit hard, and so Europe was even hit harder. But the point of the matter is, once we get stability, there's going to be in the next decade more opportunities going global. Data just shows that. Now, I can't tell you the year or what date that's going to trigger, but if we're going to have a long-term outlook, it really highlights and promotes the need for diversification. Why put all of our chips in the U.S. market? So taking that to a different level, that's an academic perspective. If we think about Wall Street forecasts, Wall Street provides forecasts. The executives at those firms, the leading strategists, share those forecasts online. And what did they say going into this decade? Domestic equity returns would be significantly lower. Better upside in international markets and a little upside in fixed income. Really, when you think about the expected return in fixed income, it's based on the current level of interest rates. That's actually the best predictor of the next 10-year bond return. We know where they are right now. So what does this mean? The last 10 years, you had nearly 13.5% annualized returns with dividends with the S&P. Wall Street forecasts going into COVID were 6.5%. After taking away dividends, 4.5%. Basically, some Wall Street strategists have come up and are starting to update their forecast following COVID-19, and that's only really going up to about 7.5%. That's about 5%, 4.5% to 5% returns after dividends. That's what you're getting in your IULs with S&P. You're getting a price return based S&P 500. You're not getting the dividends. So it's a 5% number. And when you're thinking about the illustration, was the illustration based upon a 5%? Probably not. It's probably higher. And what we see is there's better opportunities with international markets and very little opportunities with cash.
So, hey, Tom, let me just add something here. Tom, if we just back up on that one slide here, I think one of the most impactful parts of your conversation, obviously setting this up about the due diligence, this right here to me is one of the most important parts of the conversation. It's about our decision of not going down the same path as other product creations out in the marketplace. The S&P design, by the way, we love the S&P. We've had great success with the S&P. We provided great returns for S&P on our different products. But on a going forward basis, we just know that the S&P cannot repeat the same last 10-year results going forward. It just can't do it. But in the marketplace, what's interesting, distribution as in carriers, manufacturers continue to feed all of us, advisors, you, these illustrations on a 6.5% illustrated rate on an S&P, where you've got a spread of 4, 5, or 6%, which means the index has to do 11, 12, or 13. Or we've added these extremely rich multipliers. And by the way, if you're selling a multiplier today in an equity run, they will perform. I am not debating that at all. They will work, no question. But going forward, based upon the insights we're getting on forecasting, we don't have a lot of faith in those types of designs to meet the expectations of the client. So as we start to work together on future calls, we're going to spend some time around some of these indexes that we created. Tom, you created the S&P PRISM. It's tracked and validated by the S&P. It's on the Securian product. And what I love about that story, and I'm confident you will too, it's equity based. If you love the S&P, you're going to get it. But it's multi-asset. You know, as Tom said, having something that's more tactful, where it can rebalance on a daily basis and remove that volatility. You're going to have on that Securian product on an uncapped design, and the par rates are extremely attractive and they're sustainable. They're sustainable. That's S&P PRISM, a smart S&P. Then on Nationwide, on New Heights, you're going to have, as he brought up earlier, is Roger Ibbotson. I mean, Tom's friend, his partner, he created the Zebra Edge along with Mr. Ibbotson on a smarter S&P play that gives you the same equity you love, but does it such a way to get rid of volatility. And every quarter we rebalance. So you're going to have a different solution going forward, but you're going to get what you want, and that is this equity based of the S&P. And so more to come there in terms of how we're going to train you on those indexes. Tom, back to you.
Yeah, I would. Yeah, thank you. You know, highlighting, you know, there still are ways to do S&P and smart S&P. Let's not rely just on the 63-year-old S&P value concept. That's one really great takeaway you're going to start hearing from us. The other thing that this forecast analysis doesn't show or talk about, as what we've seen happen with COVID-19, is what happens if markets get volatile. You know, some could say to us, well, it's a 1 year point to point, you've gotten a zero, but next year the opportunities are probably better. That's right, except what about the cost of buying that exposure for S&P 500? Volatility is what drives the function of really what an insurance company has to factor in when giving you that S&P exposure. And unfortunately, when volatility goes up, it's more expensive for them to deliver on that. So for those that are involved with S&P strategies, you've seen over the last month now, renewal rates coming down. You know, zero's your hero, fine, but now you've gotten your renewal rate slashed by 30, 40, 50%, I've heard. Or people are using new money rates. They're not able to get the same new money rates that were being advertised a few months ago. There's lack of stability. So by doing smarter approaches, and we're going to go through that as you work with us, you're going to see not only more robust index construction to deliver singles and doubles, but that stability for rate renewal stability over time. So in an IUL, it really shines. So the last piece here I was going to share on the forecast return slide is from Vanguard. You know, we don't work with Vanguard, but as much as I think Vanguard is the leader in the mutual fund insurance, mutual group funds. You know, they are not, they're a mutual company. They're not publicly owned. And when we look at our insurance partners, the Securian and Nationwide, those are the two leading mutual insurance companies in the market. They really look at the best interest of their client value. So when you trust Vanguard's analysis here, you'd see the next 10 years, they think US equity market's going to be a lot lower. They too also believe, consistent with Bob, consistent with Wall Street, and they too also think better international opportunities. The US equity component was very sad. Jack Bogle, I referenced before, his last interview was with Morningstar in October 2018, and his last interview was the last 25 years of returns that Vanguard delivered, they're not going to be able to deliver for the next 10. And that was his last interview ever. So even Jack Bogle was trying to highlight that before he left us. So why forecast? As I mentioned earlier, it's really meant to create more realistic expectations. We're not going to tell you our indice is going to perfectly hit this return or that return, but it's creating more realistic expectations And also, when we forecast, it's a part of the diligence process that allows us to select indices that we think they're going to work on a go-forward basis. They're not just hunkered down with fixed income. That's a big issue. There's a lot of IUL indices that have shown really good returns over the last few years because they're hunkered down with fixed income. That's not the only component that's going to work on a go-forward basis. Unfortunately, probably there's nothing left. The bond market's been a tremendous return over the last 40 years, but we think it's probably over now. And even if interest rates stay the same, the expected return is so low. So that's what we're thinking about: how to do smarter S&P, how to go global, how to use factors I talked about earlier, and how to be tactical and support diversity. So thank you so much. We really look forward to working more with you as we get more into our index conceptions. Yes.
Hey, Tom, this is Kathy. We had a question that came in, which I think is pretty right on point with what you were just talking about. Question from Roy is, if we use the S&P index, how does that vary product by product and company by company? If it's invested the same, why don't we see the same results across the product lines?
That's a great question. So that's really different than the smart beta conversation. But where you're going, Roy, is that, and James knows this better than me, is we saw numerous insurance companies saying, okay, we're only going to use the S&P. We're not going to think of smart beta. And they start using those multipliers, those leverage multipliers where you're buying fees to get that upside. So all of a sudden, everything starts illustrating really differently. Well, but when you look under the hood, there's the gotchas. Not a free lunch. I think that's really been the driver why you're seeing so much differentiation within the IUL market. And I think, what we would say from an Annexus perspective, foundation of what we've done and consistent with our insurance companies is that we're not doing those high multipliers, those buy-ups. Why leverage historical S&P exposure and think that's going to work on a go-forward basis? But as a result, in illustrations, you see difference. James, do you want to add to that?
Yeah, one thing I would add to is if again, going back to the original comment that I made about the equities on a going forward basis, if you, the advisor, believe and your client believe on a going forward basis that the S&P is going to clip around that 11, 12, 13% on average going forward the next 10 years, then I am not going to get in the way of what you're selling. I mean, I want to support that. But at the same time, if you don't believe that, I think it's really important that you look at a different alternative. And I think that's the opportunity you're going to have with Agency One is these products that we're creating are just built differently. They're built on singles and doubles, as in getting on good base percentage, kind of like the Moneyball analogy, where we're not looking for home run hitters. We're looking for someone who can get on base. And if you can get on base as in a 5.5, 5 3/4, 6% return on these indexes, which is about what they've averaged, 5 to 6 in that range, you're getting your clients 7 to 8% return, and you're sustaining the par rates. You're not going to see this significant drop in cap rates. Well, let me reframe that. Cap rates are independent of our uncapped design because we're still subject to AG 49 cap rates. So if cap rates go down, they go down. But the point is the par rates are more sustainable. They're more sustainable. So we can focus on singles and doubles and we can maintain our par rates. We believe and we know we're bringing more value to the customer long term. Here's one more point that I want to add, and Tom, jump in here if you want to add something, because I know you will. We believe traditionally over time, 15, 20, 10, 15, 20, 30 years, the S&P versus our smart S&P designs, as in Zebra Edge with Nationwide or S&P PRISM, relatively speaking, over time, these indexes are going to be in a reasonable range of one another. There's not like one that's going to be 20% more. I mean, they're all going to be in somewhat of a range. But if we can provide that consistent return, but along the way, maintain your par rates, as in uncapped, and not shift them like you are seeing on a straight S&P design today, and we keep our costs low, the question is, can we bring more consistent returns and keep the volatility out of the conversation? Now, we fundamentally believe that. Tom, anything to add to that?
I think you're spot on. That's correct. I think as we work closer on our specific indices, we'll go through that mechanism. Our indices have lower volatility.
Terrific. Gentlemen, thank you so much. Terrific, gentlemen.
Kathy?
Thank you so much for this presentation. Group, you can see that we've run long. Our apologies for that, but there is a lot of really good detailed information about these indexes and the opportunity. Agency One is going to be providing further detailed trainings on these index accounts in the future, and we will be advising you when those trainings are going to take place, and certainly hope that you will participate. If you've got any additional questions, please feel free to email myself, Kathy Neifeld, or Gonzalo Garcia, and we will make sure that we address all of your questions. I want to remind everyone that continued introduction to the Annexus opportunity and the products is going to happen on Friday at noon in the final series of this WebEx. And during that Friday noon WebEx, we are going to be talking about how to use the Annexus products and underwriting large cases in today's environment. So you're going to see how you can actually place business using these products today. And we're going to give you some real case examples and show you how this can be done. So with that, again, I want to thank James. I'd like to thank Tom. I want to thank all of our attendees for their attention and their willingness to stay with us throughout this WebEx. And I hope everybody is safe and healthy, and that we will hear from you, and that you will also dial in again on Friday. Thank you so much, guys. Take care.
Thank you. Bye-bye.
Thank you, everyone.